over the summer, last quarter. So I thank everyone for being here. And the reason we don't do them at night anymore, it's, I think the recordings we do record them, and everyone gets to see them at their own leisure. So that's kind of cool. And it's right after the market kind of closes. And I think a lot of people here, and we also get some of the Europeans that are trading before they go to bed or dinner, whichever it is, or drinks, cocktails, can get a quick snippet. This is going to be a quick, fast-paced session, and the key is that we will have it recorded. So that's okay. I just want to, I should do this first, probably from a compliance standpoint. Remember, everything is risky when we trade. Nothing's free in this world. Not even quotes anymore. Some of you probably have noticed that the CME is charging to trade futures. Some are paying a lot more than others, especially if you're tagged as a professional. So with that said, trading is risky. And because nothing's free, I need to, like lawyers, if I don't show you a disclaimer, humor there, sorry, need to show this, so just take a second to read that over. Very good. All right, so, you know, unless you, how can I say it? You know, unless you've been on a vacation and you have no ability to get any form of social media contact, we're having a little event called an election. All right, so what does that mean, elections? It means potential political changes. So the Fed has been argued that they are apolitical, so they have not made any adjustments for interest rates. But the political landscape, you know, how a market's going to react to this political change. I do recall trading nightly the night bonds when it was the Bush-Gore election. And remember, I don't know if you guys remember that, when it was like 1 minute Bush was winning, next minute Gore was winning, an hour later Bush was winning, and then it had to go to the Supreme Court, or it had to go to court, and we didn't have a president for an outcome for months, and then Bush took it. So I remember trading that night, and it was a kind of a surreal experience because bonds were flying all over the place. I'm not sure we're going to get that as much, but we definitely are going to see after the election, I think, a change with interest rates. And the key, and so before I move forward, we have this presidential election, and that was going to, for those that aren't quite 100% familiar, is going to help to possibly dictate fiscal policy. Again, if the Democrats are in office, it's kind of 4 years of the same. Let's not cut any bones about it. When I first got into business in the late 70s, early 80s, actually, you know, it was always talked about that when a Democrat's in power, markets go up, stock markets go up when Democrats are in charge. I mean, I didn't make that up. It's just been something that's a folklore of the industry, so to speak. So, you know, what's been factored into the market, what's being priced into the market. Obviously, this is a market that is on pins and needles in a trading range based on two things. Who's going to be in charge? And that would help to dictate maybe some new fiscal policy changes. Are we going to have an ease in Dodd-Frank regulatory restrictions in the financial area? Are we going to see impositions in the healthcare? You know, there's a lot of, is coal's energy sector, there's a lot at stake right now. Who's going to go to the Supreme Court? I mean, there's a lot of things happening right now that the markets, for good reasons, are in this kind of stall. So in case you're not familiar, it'll be November 8th, and we may be doing something special for the election or talk about things that week. In the meantime, here's the real deal. It's quite frankly the Federal Reserve who dictates monetary policy. So we got fiscal with the elections and monetary with the Fed. And at this point in time, the next FOMC meeting is on Wednesday, November 2nd, a full 6 days, or if you think about it, Wednesday, November 2nd. Now, the Fed could have raised rates, probably should have raised rates in September. Why they did them in December last year before the Christmas, New Year's holiday is beyond comprehension, but they did. And in all honesty, many of you would probably remember Janet Yellen in front of her testimony on Capitol Hill said, well, it was only a quarter point. What does it matter? So with that quote, why couldn't you raise another quarter point back in September? It wouldn't have had any impact, at this point on the elections anyway. So we are the markets are in preparation mode for an interest rate hike. The question is an interest rate hike apt to come on November 2nd? If they couldn't do it in September, the odds of this, in my mind, is probably sub-minus 50% chance. I'm thinking there's slim to no chance the Fed will adjust interest rates on November 2nd, and I think slim left town. Slim to no chance, slim left town. But that leaves us back to the last meeting of 2016, that is, December 14th. Now the question really begins. We have, if you think about it, we've gone through the October unemployment report. We've got the November unemployment report, and then we got the December unemployment report. If we start to see job increases again over 150, 200,000, the question begs, is the Fed going to raise rates a quarter point, or are they going to raise rates and go a little bit more aggressive and play a little catch-up to a half a point? And you're starting to see traction. That's not a happy face. That's a point, a period. That's starting to gain traction, this number right there, amongst some institutional traders. That is kind of like maybe some scuttlebutt. Now, a quarter point, I would guess, is about being translated, and starting to get priced in. Let's take a look at what I wanted to discuss with you guys today. Now, I know this looks very colorful. It's pretty simple. This is a relative strength page. What does that mean? Relative strength, this is whatever I'm looking at. Like, let's take a look at this. The top, this is semis, SMH. This is biotech. So each little window represents a sector. And then you have my indicators, the person's pivots, and then you have the PPS arrows, which is also on toss, right? And then in the middle quadrant on every chart, you have this little thing called relative strength, and then you see this SPY number, right? That means what is the relative strength compared to the S&P 500? There's a little bit more to it, but let's just say if the product or the market, and in this case semis, and I'll expand the chart, because many of you are probably familiar with relative strength in the sense that when a market is strong, it attracts more money. Money begets money, right? And at this point in time, the semis, which had a little ugly day in a percentage term, we were down about 3%, 2.06 today. The semis, this is, as you can see, it's the color yellow. When the market's yellow, what that means is that this stock or sector is outperforming the S&P. So relative to the S&Ps, its percent change is outperforming. And it measures it in a divisor number, and in this case, 1.73. So basically what we're seeing is that the semis, even though they were down today, they're outperforming the market as a whole, and the market is the S&P 500. So this makes a lot of sense in just a minute. I want it to make sense now, though, right? So what we want to do is uncover what sectors of the market are leading, what sectors are lagging, and how bad are they lagging, all right? So the differential number, and I'm going to click on this diff. It says diff, and that means differential number. And I'm going to just bring this down into kind of focus for you. So that's my wife's name. I must have been typing something. All right. So, well, Twitter unfortunately failed off the 25, 26 handle, didn't quite get the 27 on the breakout. Bristol Myers, these are some stocks that I'm watching, and as you can see, the higher the number, the worse the percent change is, or the weakest it is against the S&P 500. So these are the quadrant that I look at for stocks. Strongest stuff would be the OIH, ETF, and then you can see some of the individual stocks. Airline, United Airlines, it's yellow, and it gives me the differential number, and it's pretty strong. Now, let's take a look at sectors, and as you can see, I've got GDX, which is the gold miners, I got biotech, I got real estate REITs, the IYR, utilities, I got TLT twice because I forget to delete things, XME, which is the metals and mining index, XHB, home builders, healthcare, telecoms, builders, consumer staples, listen to me, consumer staples, materials, and industrials. And then finally, the Russell, IWM. So relative to the S&Ps, it's kind of ironic that we're starting to see, I mean, of course, from last week, gold was doing fairly decent until it got in that seasonal weak period of October. But these sectors are starting to turn, and they're getting aggressively redder. In other words, they're going from a lot of these sectors were very positive, and now they're starting to turn kind of negative, red. Red if bullish, bad, okay? The more sectors that turn red, not good. If bullish S&Ps, if bullish the overall market, the more of these sectors that start to turn negative, it's not good. It's showing that there's market internal weakness within the sectors on a relative strength basis, percentage change of these individual sectors or stocks compared to the S&P 500. So I wanted to show you a couple things first and foremost, all right? So when we look at healthcare, which is the XLV, the XLV in August, the XLV healthcare, it has been going between a little bit of yellow to mostly red, a little bit of yellow to now back to red. You see those sections. So it's been detrending. It's been trending lower, XLV. And XLV, you know, it's not something that just turned negative. It peaked out in early August. But what has been very weak lately and has been detrending has been the telecoms. And this is represented by the IYZ ETF. So if you're not familiar with this, the IYZ, you can just take a look at sectors and say, gee, on a relative basis, how weak is it? It is red, and you can see it's 1.53. Now, look at something carefully with me. Where's the current price related to its highs? So when I look at something and it's red, the first thing that I notice is that relative strength-wise, it's underperforming the S&Ps. How much is it underperforming? A negative 10 or a negative 1 or 2, a negative 1.53 is not that negative. And as you can see, as the telecoms are way off their, are they way off their highs? How much are they off their highs? Not by a whole lot, right, gang? I mean, clearly, we're not off the highs that much. So under the surface, if we take a look back in time and we go, here's where we were back in the early part of January this year, we're up off the lows. In fact, if we look at where we were from a year-to-date perspective, here's where we finished the year right there, and here's where we are now. We're still up on the year, right? So the relative strength, while it's a little bit weak right now, it's not disastrous. That's the key point. It's not disastrous. So you're going to get to the, I'm going to get to the point of this in just a minute, right? Now, let's take a look at the materials, XLB. Look at the number. It's red. It looks bad. Honest to God, it's red. Because that's, you know, most people think red bad, right? And it's only negative 0.58. So where's the current price as it relates to its yearly high? It's not that far away relative to its yearly low, correct? I mean, here's the yearly low, and here we are right now. So materials, the XLB, while it's off its highs, it's not off the highs a lot, and its relative strength is not significantly negative, right? So, all right, let's cut to the chase, and I'll get right to it. What really is kind of disastrous? And one of the most disastrous sectors is utilities. And if you take a look at the utilities, that number is 5.35. So basically what this is suggesting that relative to the S&P 500, it is significantly off its highs and significantly one of the weakest sectors out there. So while we have strength in numbers or more sectors getting weak, some of the ones that are weak aren't really that weak, and let's examine the ones that are pretty much red real quick, and then we can take a health of the market. We got industrials down 0.5. We've got biotech now 5.91. You've got IYZ Telecoms negative 1.53. IYR, Real Estate Investment Trust, is kind of off the chart. We'll get back to that one in just a second. I got consumers discretionaries positive. I've got, of course, the utilities negative 5. I've got the healthcare down 2. And I've got barely a move in smidge in small cap stocks relative to S&Ps. I've got also materials a smidge negative. Now, I have a few sectors here that are all negative, right? But energy, pretty positive. Consumer discretionary, neutral, but slightly positive with a positive. And maybe I should change these colors from instead of yellow to green. But as you can see, semis, still positive. You can see transportation. We didn't even talk about transportation. Still positive, 2.26. So what does this suggest to you? Sell everything and flee? No, it's suggesting that some of potentially markets that are interest rate sensitive are sold off the weakest. Investment real estate trusts, and by the way, down 5.3%, way off the highs. Almost very, very similar chart to utilities. So I don't think you need to be a rocket scientist to say, gee, what sectors are being influenced and what markets are down? Well, the sectors that are being influenced by maybe interest rates, right, they're down hard and fast, and other sectors not so much, like energy. So last but not least, I'm going to change, instead of looking at XLV, I'm going to look at this one, guys, XLP, Consumer Staples. Now, Consumer Staples is fairly interesting because it is down, and it's been down since July from its peak. What does Consumer Staples represent? Safety, defensive, high dividend yield stocks. Pretty much that sums it up. And the Consumer Staples, a lot of these stocks were up because people were flocking into high dividend to get that dividend yield boost. And I just wanted to state to you that the market right now is undergoing a sector gyrational change right before, and it's been doing it before our very eyes. So here's, as traders, what we need to identify. A, what if the Fed only raises a quarter point? What sectors would it influence? Of course, real estate. Of course, it would influence utilities. Of course, it would influence high dividend yielding stocks. Do they have more to the downside, or have they already come off their highs? The answer is they've already come off their highs. So the market right now is trying to do two things. It's trying to handicap what the Fed's going to do after the elections and who's getting elected. So that's why we might see healthcare start to get knocked around just a tad. Now, last week in our own trading group, we kind of used this tool to identify the fact that biotechs, and in the biotech sector last week before Hurricane Matthew interrupted, major hemorrhoidus interruptus. I'm not sure that's the technical term for a hurricane, but it certainly seemed appropriate. We started to see that loss of relative strength. If you notice, look at the quadrant over here. So right in there, we started to lose the relative strength, and even though it just really couldn't go anywhere, right? Now it's at, or back down to a low of the range, and we're starting to see, this market's right back to where it started. So would the biotechs be more influenced by interest rates or by political factors? And you got to admit it's more political factors, right? And so here we are already back to support or near persons pivot support, which is 277. And here's what I'm going to be looking for. All right, I want to watch between today's close. The S&Ps were down. The overall market here didn't really feel like a major crash coming. It still kind of senses that we have maybe some sectors that might get weaker, but we just, to be honest with you, I just don't have the market saying long term we're going to zero. A correction, yes. Zero, no. This is a little minor in the biotech sector. You can clearly see I've just kind of boxed it in red, right? While the relative strength is weak, which tells me until it turns positive, it will underperform the market, and I'm not going to be looking at buying, it has the shot or the chance to maybe get back down into a little bit lower. I'm not sure, but somewhere we could see a couple things in biotech. We could continue to see a little bit of weakness in biotech, and I'm going to be monitoring a couple things. Volume, and I'm going to be watching relative strength in the biotech. By the way, the IBB would influence which sector the most? Many of you already know this answer. It would be the NASDAQ 100. There's not a lot of energy stocks in the NASDAQ 100. It's technology and it's biotechnology. So what would happen to the Qs if we continue to see further erosion in the biotech? We're going to see further weakness in the Qs. And that, I think, is where today's session, what I wanted to address to you are what tools are kind of working, and is this the time to go all in on a short position in the S&Ps? What tools are kind of working right now? So, I mean, we use some breadth analysis, and you can look at McClellan oscillator. Many people are familiar with the McClellan oscillator. The McClellan oscillator gauges based on and by the way, guys, Thinkorswim has a McClellan oscillator on it. So if you're a Thinkorswim trader, you got on TOS, you got the McClellan oscillator there, you got the person's pivots, and you got the PPS, and everyone knows that by now, I'm sure. I'm using my TradeStation analysis tools because it gives me a little wider array of some proprietary things that I've used, like that relative strength page that we've created. And I just wanted to share with you emphatically what the look-see of the market is kind of under the hood. And if it is true that the markets are preparing for a presidential election change or maybe some fiscal policy changes, what sectors are being influenced? Right now, it seems that the market is more handicapping a Federal Reserve interest rate move more so than a presidential election move. That's what this relative strength page is kind of sharing. And when I look at the breadth analysis, the advancers versus decliners, let's take a quick gander at the Dow Jones Industrial Average. I mean, this is a kind of a trading range. It breaks out of the range, and it comes into a trading range. And look at the breadth analysis on the 30 stocks. It hasn't really done anything. Look at the volume. It really hasn't done anything. It hasn't made new lows. It hasn't made new lows. And the market is sitting here in a range. So to me, this does not look completely disastrous quite yet. So do you throw the baby in the bathwater and start positioning for a massive downside? And according to these analysis and these tools, the answer is no, not yet. And that's what I wanted to go through and share with you. What else is out there besides the typical, price that many of you may use, such as stochastics and Keltner channels and Bollinger Bands and CCI, or even my own indicators on Thinkorswim, right? So relative strength tools are important. Breadth of the overall markets are important. And I think that is kind of something that we need to kind of respect in what's happening in this market. As of earlier this afternoon, so this is actually probably pretty darn close to where the market closed right now. But year to date, as of about 2 o'clock this afternoon, give or take, right? The New York Stock Exchange Composite Index year to date as of today at around 2 p.m. And if you'd like, if you give me a second, let me just share something, and I'll make sure it's how far off these numbers really are. The NYSE, for example, on a yearly basis, NYSE is 3.99%. So we went up about 0.2% from when I took these numbers. This is kind of a little strange. We're only up in the NYSE, which is where the McClellan oscillator or the tick would come in, is up 3.8%. The diamonds, the Dow Jones Industrial Average, it's up about the same amount, more or less. That really, the diamonds on a yearly basis, we did change there about 0.2% because now they're back up to 4% year to date. Year to date. These are year to date. Year to date. So SPY up, the Q's up, transports up 8.5%. How many people would have thought transports outperforming the market as a whole, meaning outperforming the S&P 500? Relative to the S&P 500, that's another indication that transports were making something, were putting them on some type of vehicular mode, such as an airplane, a truck, a ship, something, an airplane, if I didn't mention airplane already, or a railroad car. Transports up 8.5% year to date. Russell, small cap growth stocks, up 9%. Bonds, TLT, really strange. They're up 12%, but they were up pretty darn close to 20% just a few weeks back. So we've kind of, what would be an indication that interest rates are going up? Bond prices start coming down. So bonds, if we do get more than a quarter-point rate hike, all right, if economic numbers start getting even stronger, guess what might have more downside action than anything? It's probably going to be the bond prices, or TLT. It has a lot more to give up on a year-to-date basis. Guys, on a strange note, emerging markets year-to-date up 16%, EEM. The EEM is up 16%, emerging markets. Best performing sector pretty much, or foreign market, Germany, EWG, is barely up 1.5% year-to-date, by the way, and that's dollar denomination. So here's the thing that I wanted to focus. If interest rates continue up this year, we need to think a little bit and apply a little bit of logic. If interest rates go up, that's going to probably cause the dollar to maintain its posture or go even a little bit higher. So if the dollar goes up, foreign FX currencies go down. And all of these guys, right, that are doing well, maybe the reason the Dow's not doing great, maybe the reason the NYSE isn't doing great relative to the domestic growth stock story, the Russell, is because the Dow Jones Industrial Average has a lot of, obviously, preferred stock, high dividend yield, and the NYSE, whether you know it or not, about 1/5 of the stocks in the NYSE are foreign companies. Oops. So if we do see an interest rate hike, we probably have to be focusing on bond weakness, more downside TLT, and maybe the reason we would see further strength, meaning relative to the overall market, maybe the Russell gains a little bit more. Now, a few weeks ago, the Russell was up about 11%. It's only down 9%. And in the Qs, the NASDAQ 100, we might see, due to the biotech and the semiconductors, we could see that maybe come back down a little bit. And I'm thinking if we get further erosion, further weakness in the market, the Qs probably, I'm thinking if you look at where we are right now as of like 2 o'clock this afternoon, if we drop another maybe 2%, I think we'll find value in another 2% downside move in the Qs. So are we looking at the end of the world at this point in time? Is this the time to back the boat up to get long or short? The answer's no, but it is for maybe certain sectors. Now, I hope this isn't that complicated for everyone. It's just looking at markets relative than price. It's looking at markets in percent changes. And I think if we're trying to handicap what's going to happen with the election, should we be looking at price-based indicators, or should we be looking at condition-based indicators? The condition of the market is, for example, What's the volume trends? A condition is what is its relative strength ranking. Those are conditions of the market that I think will help us to maybe handicap what the potential further movement of the market is going to be. I always like to say, if you're going to try to figure out where a market's going to go, you got to ask yourself where it's been. And I constantly, and I follow this almost kind of religiously on a weekly basis, here are the top 20 sectors that I follow, 22 sectors actually, and I got them color coordinated here. Many of you will be familiar with these alphabet letters like XLY, XLV, U, XLP, XLK, XLI, E, B, IYT is transportation, XOP, oil and gas exploration, OIH, oil services, semiconductors, the SOX, XRT, retail, KRE, regional banks, IBB, biotech, ITB, builders, KIE is the insurers, and XCI is computer hardware technology. Okay, so now let me catch my breath. Here's where we start the beginning of the year. This is the zero line. Here's the Kentucky Derby horse race. IBB has been struggling all year, still as you can see, and this is as of approximately 2 o'clock this afternoon Eastern Standard Time. So give or take from 2 o'clock to the close. This is what we've done year to date. One sector is negative on the year. One sector is negative on the year. Everything else is still positive. Unlike earlier in January when everyone thought they should be jumping out a window, more sectors were negative on the year, but they were starting to climb higher out of the hole, right? As you can see. Right now, we've got XOP and semis, even with today's pullback, not much happened there in those two sectors. So I think, you know, my take of the market is, look what's at the downside of the market. We have less sectors at the upper quadrant, so it doesn't suggest to me that the market is overbought. It doesn't suggest it's overbought. So I need to be careful over the next couple weeks and into that November time frame where we have the, I doubt the FOMC is going to do anything, right? But we've got the election on November 8th. But market's already kind of pricing in, and we can start to see market's not really paying attention to the election as much. It's more paying attention to, right before our very eyes, it looks like it's paying attention to what? More interest rate sensitive stuff. So this kind of thing is to know where the markets are and relative to where they've been, what's going to look attractive over the next few weeks. And if I'm going to look for the market to go down to zero, and if I'm going to look at selling everything I own and start to buy deep out of the money puts, and I mean, you know, buy like December 12 delta puts and just load the boat up for the wealth trade, right? I mean, nothing greater than being right on a 12 delta long put. I mean, that's a long shot. You know what I'm saying? Everyone knows what I'm talking about if you're an option trader. Long a 12 delta put means you are deep out of the money and you got Hail Marys going on, right? It's a Doug Flutie option trade, so to speak, right? It's like, I don't know, if the Cubs win, it's not a Cubs trade because they do have a shot, but being from Chicago, you know, we've seen this before, so knock on wood, let's root for the Cubbies. They are in October, so that's kind of cool. So let me get off that subject real quick. What I'm trying to do at this point in time is saying, what's kind of working? And as I know that maybe in October, in early October, maybe we get a little bit more sell-off as the market scare. Then we get a, like, usually the market kind of bottoms from the last week of the month on, keyword, average. On average, it's the last week of the month of October that the market kind of bottoms. So S&P's definitely try to get a little bit of weakness going into that third week, and that's why the crash of 87, when we get to that, you know, closer to that date, you know, it was toward the last week of October, the third week, fourth week of October, and that's that seasonality that people get kind of nervous about. So I'm thinking right now, some of the sectors, unless we see a complete rollover of a lot of these sectors going down, gang, I can't get ultimately enamored in being the consummate bear, and I want you guys to be aware of that, okay? And we still need to monitor it, but I think that the evidence that I'm showing you today between the relative strength analysis compared to SPY on the individual subsectors, the chart seeing where everything's come from, you know, that to me does not spell a massive disaster in the next few weeks. Now, here's something that since crude oil's rallied, we had OPEC, and everyone knows what happened with OPEC. I think we need to kind of watch oil a little bit, because oil definitely is probably, now that we've got the hurricane out of the way in October, energy is not the greatest time to be buying energy this time of year. This is like one of the worst times of the year to start really loading the boat on energy. So I want everyone to kind of watch this. The best time of the year is when everyone says not to buy it, which is typically the first week of around February, the third week of January, the first week of February. If you go back and you look in your charts, that single time period right in here for the last 3 years has been a wealth builder. When everyone says crude's going to 20 and it's going to 0, it's been a wealth builder. Right now, this is kind of an area that's a little bit tricky, not a great time for the market. So we definitely want to say what would influence the market right here. S&Ps, weaker energy, might keep S&Ps down. Biotech, technology, if it pulls back a little bit, would do what? Cause the Qs to come down a little bit. And what that might do to you guys is it may scare people thinking the market's getting ready to really roll over, and it doesn't. So what you want to be paying attention to is confirmation, not for an index to go down short term, not for the S&Ps to maybe go down to 211, 208, maybe something like that, and then think the end of the world's coming. I think looking at the market from the relative performance, when we got some of these sectors, and if energy, and I want to focus on XLE, because XLE is in this kind of, you know, range, it's kind of breaking out. Just because seasonally it could go down, what if it only comes back to the low end of the trading range, right? It's still outperforming the overall S&P 500. So relative to the market, XLE, the energy component sector, not necessarily crude oil, but XLE component stocks, it may see a little bit of weakness and just pull back and get into the shallow end of this overall trading range, and it just would be a non-performer for you. And that might be something that could really scare you and get you into a bad trade. So it's kind of, you know, I have to tell everyone, and many of you know this, no one has a crystal ball that can tell you what hour, what day, and how high things can go. But a lot of stuff we do and the tools we use are pretty impressive. And many of you do have access to our Twitter account. I wanted it to kind of, because it's kind of funny here, but while I had to close the office down for Hurricane Matthew, let me just share something that we tweeted out on October 7th, and it's on our Twitter account. You can see this. And what's ironic is I said, hey guys, we've got this beautiful pattern in Apple, right? The volume was looking good. My histogram volume was looking good. The relative strength was starting to pop up. That's the RS chart. It was neutral and starting to pop up, right? And we said it's got a bullish PPS indicator. It had a buy signal. And it's targeting a move to 1865, 118.65, which 118.65 also coincided with the monthly person's pivot resistance, which is really wild because if you look at today's action in Apple, it's exactly where it went to. So from October 7th to today's action, that's what the market, at least with Apple has done. And there are, I just wanted to share with you how you would have traded this, whether you sold out of the money puts, bought a directional call, you know, 10 to 1 or the other, your preference. But the tools that we kind of put together are fairly impressive, and I'm just going to type this in real quick. And they can help. I mean, literally, I'm sure anyone that's trading Apple would sit here and go, my goodness, we opened, we traded, we hit the number, and we backed off. and the relative strength started to populate, and from the buy signal that we got, it spiked up. Now it didn't stay there, and that's the key you got to kind of in this environment kind of watch. But we're getting some really good setups and signals using some of these tools, and that's the moral of the story. So before I think in this environment, it's no longer, and it is probably a more computer algorithmic trading environment than at any time before. And I think this market has been kind of a, confusing for some. I've had people even today said, hey, what do you think about Netflix? Its seasonals do go down. And the funny thing is, many of you may be starting to look at seasonal analysis, and I just wanted to warn you, seasonal analysis is not the end-all. Nothing is the end-all. Nothing works 100%. But combined, if we use some right tools in combination with each other, it'll give us a stronger edge. Kind of like, as I always like to tell you guys, kind of like, epoxy glue. One component without the other is not really sticky, but put the two together and it's a very powerful one. So using the right tools, I think, and in combining the right indicators in your market analysis is fairly important. And it's important for index and sector analysis, and especially how to pick stocks these days. So what we talked about today, just to review, the strength in numbers breadth, and it's not just looking at breadth indicators, it's also strength in numbers looking at the change and the relative strength of sectors to the overall market, and looking at how do positions increase over time and the volume accumulation. Yes, we look at seasonal sector analysis, and yes, we run scans for buy signals near support or scans for sell signals near resistance. This is a chart we sent out this week to clients. This is what the market has been looking like. We have a last conditional change, which is that red bar right there, which in the ES, 2175 is the big bad boy number. Today, look at this number here, 2126.5, and we went traded below that number today, but we did not close below that number. If we're going to see any kind of further weakness, it is my contention that we needed to see a close below that level, and what would that do for us? It pretty much puts you into another trading range, and that's all we're seeing. Breadth, the advanced decline kind of weakening, but without volume behind it. Man, we're just doing another thing called buying our time, and I don't know if it's as much of the elections as much as it's the Fed, because interest rates, what makes the world go round? You all know this. It's money. Money makes the world go round, and what dictates the cost of money? Interest rates. And so the Fed is really the one at hold here and keeping this market at bay. We weren't really as interested in the election back here in July. We were interested in the Federal Reserve. And you know what? We have done nothing since July in the market, and the charts don't lie. So I would have to tell you, the market is subtly sensing a change in valuation in the interest rates rather than the smoke and mirrors of the elections, according to the work that I'm looking at. Now, things can change, of course, but I think what I wanted to share with you, and I know we've recorded this, you can go back and you can look at the numbers and look at that last conditional change, the upside breakout or the downside breakout. Those are still very important areas. And by the way, let me share something with you. Do you see the when I put an arrow on the chart, it's not just signifying a direction, it's also signifying the duration or the extent of the expected move. So if we close and break out above 2175, we're looking for the move to get right up to around that 2210. If we break and close below that 2126.5 on a daily closing basis, I'm looking for the market to get back down to approximately that 2082 level. That's the sense of this pattern and those points of interest on the chart. One's by a last conditional change to the upside, the other's by a last conditional change. These are what some of my other price indicators share with you guys, okay? So, again, think logically. Seasonally, we're going to be entering at the end of this month a strong period of time. We're going to be on hold until after the elections. We're going to be held hostage. You watch, the elections might cause some volatility, but we really want to pay attention to those interest rate sensitive sectors, and hopefully we'll come back again and share with you what's really changed. Run those buy signals. You can do it on toss. We have our own indicators on that we have with our own scans. And I think, you know, what I like to do, like a logical thinker, is if we're in a seasonally strong period of time, run scans for buy signals, especially if you're near pivot support. If we're in a seasonally weak period of time, run scans for sell signals near resistance. It's not that hard. If a market's gone up, and you're near pivot resistance, and that market starts to enter a seasonally weak period of time, you start scanning for daily sell signals. And the opposite is true after a market maybe goes down, and we've got how many sectors now that have weakened, like the telecom sector I just shared with you. So maybe we start looking at Verizon, maybe we start looking at AT&T, those type of things. Both of those stocks have gotten a little bit of shellacking right there. You know what I'm saying? So in summary, and I'll just show you what I mean by Verizon getting a little shellacking. Here's VZ. So it's got a negative relative strength to the S&P 500 ranking of negative 3.96. So that means it's gotten some, it's relatively weak. But look where it's at. It's near a pivot support target. That green line in the sand, it's near pivot support. I would want to see the relative strength appreciate. And I would like to see maybe some other indicators pop, but we're trading near support. We're well off the yearly high. We're $7 off a $56 stock off the highs. And I'm not saying to run out and buy this tomorrow, but boy, gosh, it broke out from here. It came and tested that level. It took off. It's back at it. If this thing maybe starts to subtly start to spike back up in the next few weeks, because they maybe overshot the runway to the downside, this would be an example of a market that you would say, let me run for a scan for a buy signal near pivot support. So green is support, and I would be waiting to see if we got a buy signal in a stock like Verizon. So I just wanted to, for example, give you what the heck was I talking about with these two things. So if we have the telecoms, they're oversold possibly here, and they turn into a buy, that's what that line means. Start running scans for buy signals near support. We've got a lot of stock that have gone down to support, and we do not have supporting evidence that the market's getting ready for the biggest crash of our life right now. We need more stock sectors to get weaker. We need more sectors to start falling off, and the evidence just does not support a major crash quite yet, gang. So I hope today got something for you to at least think about before, you know, opening up emails after today's downside. I'm sure everyone's email is going to be, see, we told you the crash is coming, and quite frankly, we're at the end of the, we're kind of the low end of a base. So here's where I'm going to offer you, and this is a fabulous opportunity for anyone that wants to receive my research every single week, this type of stuff that spells out things pretty concisely. It's $49 a month. It's my thoughts and observations. I do a Monday planning and scanning, which we try to do on weekends, except for when we're interrupted by hemorrhoitis interruptus. And with that said, we do the video recordings. We come up with trade ideas and chock full of great trade suggestions. So I would suggest take a whirlwind with this. Many of you already have, and thank you for your support. We work very hard at it. We provide very good performance this year, I'm pleased to say. And if you're interested, these are the kind of things that you're going to get. Attractive risk-reward opportunities, actionable trades and option strategies, email alerts and updates, seasonal sector trends, seasonal commodity spreads. In fact, I could go on and on and on. I'll just share with you exactly what we talk about. This is this week's issue. It gives you what my monthly support targets are, what I expect the market to stay within a range, what the quarterly support targets are, my technical points of interest, what the market's actually doing, I also pop through so that you can see, hey guys, we're in that range, and here's the indication of the breadth analysis. We also talk about, now that we got that clean bill of health for Hurricane Matthew, I think everyone will have a shot at reading this for this week. And of course, we had this week 265 weekly bearish LCD signals compared to 142 bullish signals. So there were more bearish coming into this weekend than there were bullish. A couple trade ideas: entry, stops, targets, holding dates. United Healthcare actually got filled yesterday. It's, up a couple bucks, $3, something like that. Weekly signals, we give you bullish, we give you bearish, we give you October seasonal trends, what changes during the month, each month, seasonal commodity spreads, and then just to keep you in tune every week so that you know what's going on, all contained in one little report every single week. If you're interested, for $50, I would say give it a try. This is the kind of stuff that we do, and you can find that by going to personsplanet.com/report, and that would be found right here. Say, take it for a shot. See if you can. I know that everyone's going to not just get an education, but you're going to get an institutional grade level of understanding of the market, and most likely make some pretty snazzy trade decisions. So I did put that into the posted that. Click on that link and you can read about it. You can sign up for that. It's about $1.50 a day. Guys, I'm telling you, this is the epitome of the work that I think you guys are going to enjoy with our analysis. So I hope you guys enjoyed today's session and didn't want to be confusing, and I hope that this relative strength type analysis is something that many of you are familiar with. A very simple term. It's called pairs trading. Many of you are already familiar with the knob spread, notes over bonds, corn wheat spread. This is nothing new. This is older than dirt stuff, but it seems to be something that I think we can take a look at and say, on a relative basis, we got a little pullback, 2%. How bad is it? And it's like, well, to be honest with you, semis, that's why I think if we only pull back, by the way, the semis, if we only pull back to where we were, 4 weeks ago, it's not the end of the world in semis. It might cause the Qs to pull back about 2%, but that would be about it, right, gang? So, in any event, can we develop better option strategies? Can you understand what sectors would do better and where your money would be better to work? Absolutely. And that's where I think this information is going to help you. I look forward to coming back here at the as it's October 10th, 11th, somewhere in there. I look forward to coming back and and seeing how the numbers look at the end of the month, meaning these relative strength and performance, the analysis from the sector. How do we look like from a perspective of what buy and sell signals on a month are we getting? Or where are we in relationship to, this is kind of cool stuff here, where are we in the monthly pivot support in the 11th hour, or the 11th day of the month, shall I say? Industrials, XLI is at its predicted monthly pivot support. IBB is at support. Spiders at support. GLD went below its support, and GDX is below its support. By the way, for the new quarter, these sectors are already at their respected targeted support levels for the quarter. And so we really don't have a huge change or a lineup on a longer term basis. On a quarterly basis, you can see everything just says bullish here. So until I start seeing real definitive changes technically, yes, we're looking for a correction. No, I'm not looking for the big kahuna, DEFCON 4. Don't load the boat up and deep out of the money puts. And that's what today's session was designed to give you some insights for. Take a whiz, try $50. I think you guys will be pleasantly surprised. Everyone, I am not going to be in Las Vegas this year. for the Traders Expo. So have a great time out in Vegas without me. If you're interested, we'll be here working from, let's call it Studio A here in North Palm Beach, Florida. And then I will be in Germany, and I will be in South America speaking at other conferences out of the country. So with that said, everyone, may the best person win the election for our country, and may the Federal Reserve finally do something with interest rates and keep this market, from being held hostage. I appreciate everybody being here, and I hope you got something out of this. Take care.